Every quarter, the chief executive and chief financial officer of a U.S. public company put their signatures on a statement that says the financial numbers are true. Sign it knowing those numbers are false, and the law allows for prison time. That single idea sits at the heart of one of the most demanding rules in corporate finance. This is SOX, and here is the calm, factual reason it earned its reputation. To understand SOX, you have to start with the failures that produced it. In the early 2000s, American capital markets were rocked by a run of accounting scandals that are still taught in business schools today. Enron, once one of the largest energy companies in the United States, collapsed in 2001 after it emerged that the business had used complex accounting to hide debt and overstate its profits. The following year, in 2002, the telecommunications giant WorldCom failed in what became one of the largest accounting scandals of its time, built on billions of dollars of misclassified expenses. The human cost was heavy. Investors who trusted the published figures lost enormous sums. Employees who had tied their retirement savings to company stocks saw much of that money vanish. And the damage spread to the watchdogs themselves. Arthur Andersen, one of the largest accounting firms in the world and the auditor linked to Enron, did not survive the fallout, and its collapse eliminated tens of thousands of jobs. Lawmakers drew a straightforward conclusion. If the executives certifying a company's books could not be relied upon, and the auditors who were supposed to check those books could not be relied upon either, then confidence in the entire public market was in danger. Congress moved quickly to respond. The response was the Sarbanes-Oxley Act of 2002, named after its two congressional sponsors and signed into U.S. law on the 30th of July, 2002. Most people simply call it SOX. Strip away the detail and the law has one central goal: to make the financial reporting of public companies more honest and more accountable, so that the people who invest can trust what they are reading. The broader aim was to restore the confidence that the scandals had drained from the markets, by making accountability something visible and verifiable rather than simply assumed. Its reach is specific. SOX applies to U.S. public companies, the businesses registered with the Securities and Exchange Commission, together with their senior management and the public accounting firms that audit them. It also crosses borders. Foreign companies that list their shares on U.S. exchanges are generally covered by the same requirements as domestic ones. The law also built a new institution. Before SOX, the accounting profession largely set and policed its own audit rules. The Act created the Public Company Accounting Oversight Board, known as the PCAB, to oversee the audits of public companies and to write the standards those audits must meet. In effect, it placed an independent referee between companies and the firms hired to verify their numbers, a structural change that shifted audit oversight out of the profession's own hands. SOX is a lengthy statute, but a small number of sections carry most of its practical weight. Learn these four and you understand most of what the regime feels like from the inside. Section 302 covers certification. Every quarter, the CEO and the CFO must personally sign a statement confirming that the financial statements are accurate and that the company's disclosure controls are working. Their names go on the line, individually, in every reporting period. Section 404 is the one that finance teams discuss most. It requires management to assess and report on the effectiveness of its internal control over financial reporting, the collection of systems and checks that keep the numbers reliable. Under the provision known as 404(b), the external auditor must also give an independent opinion on those controls. Smaller companies, classified as non-accelerated filers, are exempt from that auditor attestation, although management's own assessment still applies to them. Section 906 sharpens the consequences of certification. Knowingly certifying a financial report that is false is treated as a criminal offense, carrying penalties that can reach fines of up to $5 million and prison terms of up to 20 years. Section 802 addresses the cover-up. Altering, destroying, or falsifying records in order to obstruct an investigation can carry penalties of up to 20 years, and this section is the main reason companies maintain such strict, defined rules for retaining documents. Several other provisions round out the law. SOX requires the board's audit committee to be independent of management. It bans most personal loans from a company to its own executives. It protects whistleblowers who come forward to report wrongdoing. And it reinforces auditor independence by limiting the non-audit services an accounting firm may sell to a company whose books it audits. Taken together, these measures were meant to remove the kinds of conflicts of interest that had allowed the earlier failures to grow unchecked. What truly separates SOX from many other frameworks is that it reaches individuals, not just the organization. In a lot of compliance regimes, a violation means the company writes a check. Under SOX, the certifications demanded by Section 302 and backed by the criminal provisions of Section 906 place responsibility on named people, specifically the CEO and the CFO, rather than on the corporate entity alone. It is worth putting those figures in context. They are the ceiling for the most serious, deliberate misconduct, not a routine result, and they apply to knowing wrongdoing rather than to honest errors or good faith judgment calls. Even so, their mere existence changes behavior throughout an organization. When a signature can carry personal and criminal weight, senior executives tend to ask sharper questions, insist on stronger documentation, and press their teams to be sure of the numbers before anything is filed. That ripple effect is exactly what the law was designed to produce. If the penalties explain the caution, the daily workload explains the expense. Complying with SOX, and Section 404 in particular, is a continuous, year-round exercise rather than a single filing. A company has to identify the controls that protect the integrity of its financial reporting, document in detail how each of those controls works, and then test them to demonstrate that they genuinely operate as intended. The work is detailed and evidence-driven, because it is not enough to state that a control exists, the company has to show, with records, that it functioned throughout the year. Because it repeats annually and touches so many functions at once, finance, internal audit, information technology, and the external auditors, it becomes a permanent fixture of the corporate calendar. The cost is tangible. Building and maintaining documentation at this level of rigor consumes staff time, specialized software, and external auditor hours, and for a large company the annual figure can be considerable. That pairing, real personal liability for executives on one side, and a heavy, repeating burden of documenting and testing controls on the other, is what makes SOX one of the most demanding compliance regimes a public company will encounter. Its reputation, in the end, is less about drama and more about relentlessness and the fact that it never really switches off. If this made SOX clearer, subscribe to Compliance Decoded for plain language breakdowns of the rules that shape modern business. And tell us in the comments which section you would like unpacked in its own video, the internal control demands of 404, or the whistleblower protections. We read every comment. Educational overview only, not legal or compliance advice. Consult a qualified professional for your situation.